This is problem 51A that's on page 174 in your textbook. I'm going to go ahead and do the closing entries. A good way to remember the closing entries is to think of a four-letter word, R-E-I-D, and I sent you a handout the other day. R is to close the revenue accounts, E represents the closing of the expense accounts, I is closing the income summary, an account that we use only for the closing entries, and D is for closing drawing. The purpose of the closing entries is to bring capital up to date and to start off fresh with revenue, expenses, and drawing for the next fiscal period. So I'm going to start with the information that's on page 174, where it gives information from lines 7 through 14 on that worksheet. We're not concerned with the assets or the contra assets or the liability accounts, but just everything from capital on down. And so I have the balances filled in for capital and for drawing the debit, and then revenue has a balance as given in the book, and here's rent expense, supplies expense, depreciation expense, office equipment, and utilities expense. So we're going to go ahead and close these entries now. So keeping in mind that when you close an account, you make the balance go to zero and you transfer that balance somewhere else. We can't just do something with the T accounts. We must first use the general journal. So I have this to reference, but we're going to go now to the journal page in your workbook. And this is the closing entries. Now typically when you do a closing entry or you do any entry, you put your description last, but when you're doing the closing and adjusting entries, you put that first. And this is for 2010, and the month is May, and it's the last day of the month, so it's 31st. Okay, looking at your revenue account, revenue has a credit balance of $3,897. So to make that go to zero, we would have to debit it for that amount. Once that goes into the account, the difference between the debit and credit side would be zero. We're transferring this amount to our new account called Income Summary, whose sole purpose is just to help us out when we do closing entries. So we're going to credit Income Summary for the same amount. Going to skip a line. It's going to be again the 31st, and we're going to close all of the expense accounts. Now the expense accounts have debit balances, so we have to close them as credits one at a time. We're going to debit Income Summary. We're not sure how much yet, so I'm going to leave this blank, but we're going to list all of the expense accounts, which is rent, and that has a balance of $790, so we have to credit it to make it go to zero. We're going to credit supplies expense for $381, which will make it go down to zero. We're going to credit the depreciation expense, office equipment, for $520. We're going to close utilities expense by crediting it for its balance of $276. And last, we're going to credit miscellaneous expense for its balance of $118. Now when doing that, when we add up all of these credits, we would know that our debit would have to be the sum of these. So that would be $2,085. So right off the bat, we know we have revenue of $3,897. Our expenses are $2,085, so we know that we have a net income this month. The third letter in the word read, R-E-I, the I stands for closing the Income Summary account. Now Income Summary account, if you credit it for this much and you debit it for a smaller number, it's going to have a credit balance of the difference between these two. And the difference between those two is going to be debited to Income Summary, and this is for 1812. Know what this is? It's the net income. The net income is the difference between the revenue and the expenses. We're going to credit the capital account because the purpose of the closing entry is to bring capital up to date, and the net income increases capital. Fourth, REID, D is for drawing. We're going to close drawing. Now drawing has a debit balance, so we're going to have to credit drawing. We're going to debit capital because what that does to capital is drawing is a minus to capital. Just like in chapter 1 we had drawing in the capital column with a minus, it's a decrease to capital. And we're going to credit drawing to make it go down to 0. So these are your 4 closing entries. Excuse me. We close the revenue account into the income summary. We close all the expenses in the income summary. We close the income summary, which is the net income or net loss here, into capital, and we close drawing into capital. So I'm going to stop this for right now.